Guys, welcome back to my channel. Continuing with the topic of revaluation, few more adjustments are here with the balance sheet which is also given. Thinking over here, same case, there are two partners A and B, let their profit sharing ratio is 3:2. So here are the few more cases of the adjustments which we need to adjust through revaluation account and revaluation account and your balance sheet or the capital accounts. Revaluation account, I have already told you, it is a nominal account in which all the losses are to be debited and all the gains are to be credited, right? And except to that, we have capital accounts. In the capital accounts represents your which account? That is your personal account. Capital accounts represent your personal account. So here A and B, whatever brought into the business is to be credited because they are the givers. If they withdraw something from the business, that would be debited. Okay? And then in the last case, we have to prepare the balance sheet also to show liabilities and asset status of the firm. So we are provided here with the first point that an expense of 2000 were paid by the firm for getting value of land and building certified from a chartered engineer. Here there is no increase in the value of the land and building, rather they have to get it certified, for which they have paid a sum of rupees 2000. So here what is happening? Amount is going from the business, that is with rupees 2000. Money is going, which account is to be credited? Bank account is to be credited. Now which account is to be debited here? Not land and building. Why not land and building? Because here an expense of rupees, how much is incurred? That is 2000. So it is an expense in the case of admission, retirement, change in profit sharing ratio, death. When you have to prepare revaluation account, expenses would be debited from which account? That is revaluation account. From here on the debit side, because it's an expense, so the entry goes revaluation account debit to bank account with rupees 2000, and in the balance sheet your bank would be given a less with rupees 2000. Whatever bank balance would be there, that would be given a deduction with rupees 2000. After that, he says stock is to be increased to 2,20,000. Increase to means what should be the new value of your stock? Its new value should be 2,20,000. It should be increased to, that means its value should be 2,20,000. Now earlier its value was 1,80,000 and now its new value is of 2,20,000. By how much amount we have increased the value of the stock? From new value we deducted their old value, we got a increment of rupees 40,000 here, a gain of rupees 40,000 here. So in the revaluation account we will write by stock account with what amount we have to write it, that is with 40,000 rupees. Done. So stock is now valued in the balance sheet for rupees 2,20,000. Now the next point is furniture is to be reduced by rupees 20,000. Here word is written by, that means this is the reduction value given to you. This is the reduction value. So this is a loss on the furniture value of rupees 20,000. Losses are to be debited in the revaluation account. So when the losses are to be debited in the revaluation account, we will write here word furniture. Furniture is reducing by how much value? 20,000. So what should be the value of furniture in your balance sheet? In the balance sheet, 2,40,000 rupees would be reduced with how much value? 20,000. Now it would be recorded with 2,20,000 here. Got it? So furniture value is reduced, that's why it's coming on the debit side of your revaluation account. It is a loss on the asset value. The next is out of the journal reserve. He says 10,000 is to be kept aside for the provision of the doubtful debts. General reserve was of value 22,000, out of which 10,000 is to be kept aside for the provision of doubtful debts. Now here, the provision for doubtful debts already were existing with rupees 10,000. How much more provision is required? That is of 10,000. First of all, earlier there were provision with rupees 10,000. Now more provision is required with 10,000. That means from the debtor's value of 8,20,000, how much provision we will deduct? That is 20,000. So what would be the value of debtors? That is rupees 8 lakh. How much we deducted? The old provision also and the new provisions 10,000 also. But this 10,000 provision is not from your revaluation account, because in the question it says that general reserve is to be used to create the provision. So general reserve is used for the provision, means the debtor's provision would be taken out from general reserve. Now general reserve was of rupees, let's say it is of rupees 20,000, and from 20,000 if we deduct 10,000 for provision for debtor's loss, then how much is left for the partners here A and B? How much is left? That is 10,000. From 20,000 general reserve, 10,000 is used for debtor's loss. How much is left here? That is 10,000. Now this 10,000 belongs to old partners in their old profit sharing ratio as a free reserve. Fine. Whatever is left after meeting out the any loss or liability is your free reserve. So here free reserve is of rupees 10,000. Now this 10,000 goes old partner, old profit sharing ratio. So 10,000 into 3 by 5 give you 6,000 here and 4,000 for B. So in A's and B's capital account, buy general reserve, because general reserve carries which balance? Credit. Now we want to distribute it, so it would be debited. So entry is general reserve account debit. That's why by general reserve, A's capital account would be credited with 6 and AB's capital is with 4,000. If you see general reserve here, out of 20,000, 10,000 was going to provision and left 10,000 was distributed among the partners. So no general reserve is left here. Now this point is finished, but in the balance sheet I have written one more point, that is employees provident fund. Employees provident fund which is payable to the employees at the time of their retirement. So EPF is a liability of the firm, of the business. It is not a free reserve. It belongs to your employees. It belongs to your employees, which would be paid at the time of their retirement. So as it is not a free reserve, it cannot be distributed. That means it stays in your new balance sheet EPF with the amount of rupees 10,000. It will not be given to the employees or the revaluation account. So here were these 4 adjustments and this adjustment. One thing I want to tell you over here, adjustments we have done all 2 places, but this balance sheet value, no adjustment was there. So we took this to only one place, not at 2 places, because whatever is given in the balance sheet, that is taken into the new case only one place. Whatever adjustments are given in the question, that goes at 2 or 3 places as per the division cases, right? So this is for the day. Accountitude, like, share and subscribe. Keep scoring.